Hi, and welcome to today's session. Before we start, I'd like to say that today's session is one that requires a particular type of expertise that is definitely going to be beyond the scope of this course. This is an introduction. We're going to talk about certain topics that will give you an idea how taxes work, but we're not going to give you the definitive answers. For that, you'll have to check on the most up-to-date research. Things change in taxes all the time. People are specialists in taxes for a very good reason. This particular session is intended to be part of our overall course in financial planning, and as such we're addressing it very early in the program. I guess in a way we'd like to get this out of the way so that we can get on to some of the perhaps more interesting stuff. But taxes are important, and that's what we're going to be looking at today, taxes and also the use of tax strategies. We'll start off by taking a look at how income taxes work, and the particular focus here is income tax in Canada, although many of the principles are going to be applied similarly in different places around the world, and certain concepts can also be applied at the corporate level. In Canada, most Canadians have to file a tax return. There's a long list of required conditions that make you liable to produce a tax return every year, especially if you owe taxes from previous years. If you want to claim a tax refund, if you're eligible for certain tax credits. And here I also want to point out that there are a lot of acronyms in this particular part of finance. So things like GST, the Goods and Service Tax, the Canada Child Benefit, the Canada Workers Benefit, and so on are good examples of that. And of course this is enforced by an agency called the Canada Revenue Agency, or CRA. And if you owe tax to them from previous periods, then definitely you have to file a return. If you want to make certain adjustments, for example, splitting income between a higher tax bracket and lower tax bracket spouse, that would also be another reason for doing this. And also if you want to carry forward certain expenses that have been paid and are tax deductible, for example, like education expenses. But this is only a partial list. The list is actually much longer. When we file a return in recent years, the alternative ways of doing this have become easier and easier. Well, of course, we can still get the paper version and file a hard copy tax return, although the Canada Revenue Agency definitely encourages people to use the online filing service called NetFile. And if you go to the Canada Revenue Agency website, you'll see a list of their accredited providers. Most of the major software companies that help with tax tax calculation are there. And so, for example, if you take a look at TurboTax or QuickTax or any of the other sources like that, you'll see a page like this that reminds you in the top corner that you can use this to file with NetFile. And they give you a menu of different alternatives. If you're a student, you can probably just use the free version of this, but if your taxes become at all complicated, you're probably going to have to use one of the more expensive versions. Excuse me. The steps that are involved in tax calculations are the ones that we're going to walk you through in this first session. We'll start off with, of course, well, we don't even need to basically say that the first thing that you do as part of the tax filing process is to identify yourself, your social insurance number, a number of particular details that you want to record with them, like whether you want to be on a voting list or not. Then we have the next three steps are really about calculating your total income, calculating your net income after certain allowable expenses, and then determining what your taxable income is. From there, we have to take a look at how much you are likely to owe the federal government, the provincial government, and to determine whether or not you have an overall refund or whether or not you owe them some money. This is not really going to be, and none of this is really going to be voluntary. You can't have your name taken off the list if you don't like to do it or don't want to do it. And it's something that needs attention. It's kind of like, leaving that milk in the back of the fridge and assuming that if you leave it there long enough, it's going to go away. Well, clearly taxes that are ignored are never going to be taxes deferred. You're still going to be liable for the outcome of the process. Determining taxable income starts off with adding up your total income from all sources. From this you can subtract the number of deductions. We'll talk about that in a minute. That gives us the net income. And then there may be certain other allowable deductions that are available to you, and that provides us with taxable income. Your total income includes things like the income from employment, any pension income, investment income, income from self-employment, rental income on properties that you may own, and pretty much any other kind of income, including, of course, any overseas income, has to be declared along with those taxes that are paid overseas. There are a number of documents that we are probably all aware of that we've seen in the past. The T4 is probably the most common. So if you've had a job where tax was deducted at source, you will be issued a T4 form by your previous employer. Today it may be done online. And usually when your employer provides you with that information, they're providing the government. So a lot of that will already have been registered in one of those programs that you use, like QuickBooks. There are a number of other types of tax deduction forms for investments or for pension income, something like a T5 form, for example. There are a number of regular deductions that most people have some form of deduction available to them. If you're making pension payments through a company pension plan, if you make RRSP, Registered Retirement Savings Plan contributions, that's going to be another source of deduction. If you have to pay union or professional association dues, moving expenses, childcare expenses, certain types of allowable interest costs that we describe as carrying charges, things like that, all can be deducted from your net income or to provide the net income. There are certain other types of deductions that are not income related. For example, capital gains or capital losses may be deducted. And that doesn't come from your active income, from employment or pension funds and things like that. That comes from owning property and sale of property or sale of investments during a particular year. So losses would be tax deductible. Capital gains would be a source of income. And you can also, in many cases, use losses that have been carried forward from previous years. If you had a capital loss in a previous year, for example, and you used up all of your deductions for that year, then you could carry that loss forward into the next year and use it against your current year's income. So from net income, after we take away these deductions, we now have our taxable income. And the taxable income calculations are something I think a lot of people recognize as being part of a painful process of collecting information from a variety of sources, worrying that you've missed out on certain deductions because you forgot to keep some of the records. You know, that charitable deduction, for example, that you made at Christmas to the food bank. Is that something that is there in your box of receipts, or is it something that you've lost and need to find? So people describe this process as being quite painful. Determining our total tax payable comes in two different steps. So we have to look at the federal tax payable based on our federal tax rate and our provincial tax payable. And that combined provides the total tax. Our federal tax is essentially the taxable income that we've determined times the appropriate federal tax rate minus any of the tax credits that we've discovered. And that gives us our basic federal tax. Now, before we go on any further, I wanted to talk a little bit about tax rates. There are two different tax rates that we tend to talk about. One is the average tax rate, and we get the average tax rate essentially by taking a look at the last year or the last accounting period that we've used and take the total taxes that were payable, divide that by our total income. You probably have a pretty good idea what that looks like. Over the last year, you paid $10,000 in taxes, you had $40,000 in income. That looks like about a 25% average tax rate. But we all have experience of having received a little bit of extra money, perhaps close to the end of the year. We worked some extra shifts around Christmas. we expected to get a much higher amount of money in our last check, but it was reduced. And that's because tax rates operate on an escalating scale. The average tax rate over the whole year doesn't really represent the tax rate that you have to pay on the last dollar that you earn. That's where we talk about tax brackets. The marginal tax rate is really all about those tax brackets. You can see from this information that's provided somewhat indirectly through Revenue Canada that the tax brackets that were relevant for the last year basically say that if you earn up to about $14,000, you don't have to pay anything. If you earn $49,000, you have to pay 15%. The next tax bracket's 21%. The highest tax bracket for people that earned more than $216,000 is basically 33%. So if additional earning at the end of the year pushed you up from one tax bracket into the next, the deductions at the margin, the latest tax information, would be at the higher tax rate. And that's why it looks like you've been ripped off at the end when you see your last check and you see that it's worth less. There are a number of non-refundable tax credits that we need to be aware of. The personal deduction, a married deduction, old age credits if you qualify, pension credits, Canada Pension Plan credits for actual amounts paid to Canada Pension Plan, paid into, your employment insurance contributions, and any disability credits. This is not really an exhaustive list. You can see there are a number of other things like tuition and education, medical expenses, charitable donations, even gifts to the government. All of these things, and perhaps even more, will be included. I know several, for example, that aren't on this list that probably don't really want to talk about today because it makes the story much too complicated. The most important, something that everybody gets, is the basic personal amount. So, for example, this year, most Canadians will have a non-refundable credit of about $14,000. And on top of this, there may be an allowance made for a non-income earning spouse or partner. If you're over 65 and earning less than a certain amount of money, a disability credit if you qualify with certain disabilities that have been agreed with the government, and if you're an active caregiver working with somebody who needs full-time or at least part-time care. Provincial tax payable operates differently in every province. Probably worth noting at this point that Quebec does everything differently. They manage all of their own taxes, but for the other provinces, there is a federal section and a provincial section. The taxes for the provincial part are calculated after the federal taxes. The tax brackets are actually a little bit different from one province to the next. So, for example, we'd see that the tax brackets start at a lower minimum value with a very low 5% tax rate and have a different top value of $222,000 versus $216,000 for the federal one, and that there are different tax rates for each of those, subject to change every time government produces a budget. So these numbers are from the most recent information, but they'll be different by next year. There are a number of refundable tax credits that come after the calculation of tax due, and these include the taxes that you've already paid, installments of tax if you're on a quarterly installment basis, which is what happens quite often to self-employed people. They'll be contacted by CRA and told they need to pay a certain amount up front. There's Canada Pension Plan payment, overpayment of premiums, overpayment of unemployment premiums, and GST tax credit if you're allowed to use that credit. After all of these deductions, we may still owe some tax, or at this point we may have a refund. So there you go. That is the first part. That's a little bit about, a very little bit about the makeup of the income tax in Canada. The second part of the story involves the strategic tax planning part. This is actually an entire course that we teach at VIU for students that are going to go on to do the Certified Financial Planner designation. Tax planning, essentially, is a process where we look at the goals related to tax planning. We have to have a solid understanding of tax laws as they stand and as they are changing. We need to be able to maintain, for a very long period of time, complete records, even more than the 7 years that the people say that you have to keep. And ultimately producing, from information that we have, financial decisions that can reduce your tax liability. Because of course, in the end, it's not just how much money you make, it's how much money you get to keep after taxes. You can see that in Canada, our tax structure, compared to the other OECD countries, is actually quite heavily weighted towards income tax. In Canada, the average tax rate, on the left-hand side of this chart, as you'll see, shows that the average tax rate is about 36% compared to the other OECD countries where the average is only 23%. We also have slightly higher taxes on companies and on payroll taxes and on property, but we have offsetting that lower tax rate, especially on things that are very important like the value-added tax, which we call the goods and service tax. We're about 7% lower than the average in other OECD countries. This data, of course, is from the OECD in their most recent tax report. Province to province, state to state, we have different tax rates. And this table actually looks very different when we compare it to other provinces and other states at different levels of tax. So at a $75,000 tax rate, you pay about 28% in British Columbia versus closer to 40% in Manitoba, closer to 30% in Ontario, and again almost 40% in Quebec. So income tax rates do vary from province to province, and they're typically much higher than they are in the United States. Now, if we were to look at this for a marginal tax rate of $200,000, we would see much higher values across the board, but especially high values in provinces like British Columbia, where we have very steep progressive tax rates. That creates an interesting problem or an interesting opportunity. If it's your money, it's your problem. How do I manage to have a benefit from extra work and extra income? And if you're a financial planner, the opportunity is, how do we help our clients to reduce their taxable income, to get them down to the lower tax bracket where they pay the lower rate of tax? And when we hear about people like Bill Gates or Elon Musk earning billions of dollars and paying very low tax rates, it's because of tax planning. They've been doing the kinds of things that the government says you need to do in order to reduce your taxes. Nothing illegal, probably, but they've just been very careful about their tax management. Here's where we start to talk about some of the standard terms that are very important and very critical distinction. We talk about tax planning or even tax avoidance. Those are legitimate ways to reduce your taxes. If you go from tax avoidance to tax evasion, at that stage you're making use of illegal approaches and strategies, and you can get huge fines and go to jail if you do that. And if you provide advice to somebody about tax evasion, that's even worse than being the tax evader themselves. You can see that even for relatively low income people, access to tax information is much better than ever before. It did used to be that you had to go to a tax planner and put some money up front, pay a flat fee, and perhaps pay extra money for particular advice over the year. That could be quite expensive, so you probably didn't seek tax planning advice until you got into a relatively high tax bracket. Now, with sources online, everybody can get that information. In fact, even the Canada Revenue Agency website has become reasonably helpful as compared to past years, where after you got past 5 or 6 different passwords, they would give you information that probably should have been freely available to the public. So these are a couple of sources I thought I would mention right up front, because it's certainly a good place for everybody to have a browse around to see how they're doing on their taxes. How can they actually get more of their own money after taxes are paid? Some of the standard strategies that we're likely to use, using tax-exempt investments. There are higher tax rates on different types of investments. For example, looking at capital gains versus passive income that's paid through dividends could be a very different rate of overall tax incidence. Tax-deferred investments basically say that we're not going to avoid the taxes completely. We'll pay them at a point in the future, and we'll talk about some of those strategies in a minute. Looking at tax-deferred retirement plans like RRSPs, Registered Retirement Savings Plans. Making purchases that will effectively be deducted as job-related. And if you own your own business, or if you have a partner, there are opportunities to reduce your income at source through business expenses and through splitting of income. First off, the tax-exempt investments. One of the best ways to avoid paying taxes is to take advantage of capital gains tax. Capital gains tax essentially charges you only half the rate that you would pay on income tax. The idea is that you made money while you were operating or owning that asset, and that you paid income tax on the profits that you got while you saw those gains. You probably didn't get any kind of interest deduction while you had those, and so in the end, the capital gains are at least partly yours and only partly the government's. And so there, for that reason, capital gains are usually taxed at half the rate, or at least in Canada. It's very different from one country to the next. So your primary residence is probably the easiest way to avoid even capital gains tax, because if it meets some very simple conditions, the sale or the gain on your principal residence is not taxable. And that's not true for your cottage, and it's not true for a rental property. But that's certainly a good place to start. We also have something that is relatively new, our tax-free savings accounts, or TFSAs. And we say these are tax-exempt because you're going to use your after-tax income to contribute into a TFSA, but the gains that you make from the TFSA's actual income, from capital gains that you got from investment companies and dividends or interest that you received as part of the normal TFSA account activity, those things are typically going to be not taxable. You can open a TFSA after your 18th birthday, and there's a standard amount that's going to be allowed for new deposits each year. And for every year after your 18th birthday, you're allowed to accumulate the unused contribution. Perhaps you can't afford to make an investment this year or next year, but 3 years from now when you start, you can actually use that contribution room that you didn't in previous years. We've had TFSA since 2008, and so you can see that if you were already 18 in 2008, you could have contributed $5,000, $5,500, $6,000. Something went on in 2015 and said that you were allowed to invest $10,000. They gave you a double the contribution allowance. So if you were already 18 in 2008, today you could invest up to $81,000 of your after-tax money, and any returns to that would actually be quite consequential. If you got a 5% rate of return, it would be about $4,000 in income and about $1,500 in tax savings. So definitely a very good and interesting strategy if you're going to invest anyway. As compared to the tax deductible investment, we have tax deferred, and capital gains essentially means that we don't have to take a gain until we actually realize the gain. In other words, you buy some shares in Amazon, you held on to them for 5 years. When you sold them, you had a 30% gain, and say you got $3,000, that would be a capital gain. Well, you're going to be taxed on that $3,000 at the lower capital gains tax rate. However, you don't have to sell them this year. You could wait till next year or the year after, and there is no realized gain until the time that you actually sell, till you crystallize that gain. That's true for real estate, it's true for bonds, it's true for investments directly in businesses, that we can actually put those off perhaps until we have a low earning year. Maybe we decide to take a year and spend it on the beach, have no income from employment. That might be the year we decide to sell a business or sell some shares, take the capital gain, and pay at the lowest marginal tax rate. RRSPs are the other big category. In fact, there are a lot of different retirement plans, not just registered retirement savings plans, that benefit from tax deferral. RRSPs are the most famous. There's a whole season in the investment business that is all about getting people to invest in their RRSPs. That's partly because we can go for 60 days after the end of the year and still deposit money into our account for the previous year. There is a wide variety of possible investments, including things like stocks and bonds, even direct investment in real estate if your fund is large enough. You can even leave the money in cash inside of an RRSP, or bitcoins, I think, although I'm not quite sure about that one. There are a variety of registered pension plans, RPPs. They're typically run through your employer. We also have locked-in retirement accounts, which are transferable RRSPs that often follow you from one employer to another. Deferred profit-sharing plans work just like RRSPs, but they're part of a company profit-sharing plan that's been registered by your employer with the Canada Revenue Agency. Now, beyond these type of tax deductible and tax deferred opportunities, we have a number of deductions which are also going to be tax deductible, like union dues, travel expense for education perhaps, education costs, investment in business tools that you needed to operate as a sole proprietor, and so on. Registered education savings plans are also worth particular mention. Now, investment in an RESP is another type of tax-deferred opportunity, which in some cases, to a limited extent, is going to be matched by government grant investment. So you start an RESP for your nephew or your children, and then that will build over time until until the beneficiary, the child or the nephew, niece, goes to school, at which point it can be drawn down, which becomes then, at that point, taxable. But first off, there's the money that's provided by the government as matching funds, and then there's also the time value, which means that by the time your 10-year-old niece or nephew gets to university, that small contribution to an RESP can grow into a fairly substantial amount of money. Once you're in education, of course, there are a number of deductible education costs. I'm not 100% sure that all of these particular categories are exactly the same as they were last year or even last month. They do change from time to time. Tuition is the most obvious one. Lab expenses, library fees, transit passes, textbooks, but not things like student association fees, gym fees, and so on. Parking, board and lodging expenses, and so on. So those are things that can be saved up in an account. Essentially, you can put that into your deductible education amount. You record it every year. Take advantage of the tax deduction that you can use in that particular year, I think up to about $5,000, and then carry forward the remainder or transfer to your favorite relative so that they can use it on theirs. Owning your own business allows you a certain amount of tax deduction. It changes every year. Last year it was a little bit more than $892,000 in capital gains exemption from the eventual sale of a business for certain qualifying businesses and farms. You can also deduct certain types of expenses like health insurance, business use of your private home, rent, mortgage, the capital cost allowance or that particular version of depreciation, utilities, insurance, even interest costs to a certain extent can be deducted from that as a business expense, and property tax. This became an interesting issue during COVID because a lot of people became people operating from home working from home, and under some circumstances, individuals employed by a company could also claim those deductions, but to a certain limited extent. And even if you couldn't, even if your employer would not provide the documentation, you could still get a fixed amount for working from home, something that will probably continue well into the future. Canada student loans are an interesting question. Loan interest in general for individuals is not tax deductible. That's one of the reasons why they give us a break on capital gains. However, under the Canada Student Loan Program, Canada student loan interest is deductible. So if you do have large amounts of student loans outstanding and you're going to be paying an awful lot of interest for years to come, there's always a bright side. It will be tax deductible. Something else you might have heard about is splitting income. And this is often the case where one partner has a high income and the other partner has a lower income because of the marginal tax brackets. It would be an advantage to taking some of the income from the higher earning individual and transferring that to the lower earning individuals, so that with a certain amount of equalization, the average tax rate that you pay would be less. You can do this a couple of other ways as well than doing it on your tax forms. You can contribute to your spouse's RSP. And in some situations, if you're operating a business or operating like a business, your spouse or child can be paid for their work, and of course that would be transferring money to a lower income member of the family. Now, our last topic is kind of what goes wrong, or what can go wrong. And of course, everybody lives in fear of a tax audit. They're not quite as common as they seem, but as you'll see in a minute, they are much more common in certain circumstances. Canada Revenue Agency can audit just about anybody in any circumstance. Essentially, audits happen all the time, perhaps even without you knowing about it. Perhaps you get a phone call or you get a letter saying, please provide certain documents, because large files will be gone through at very little amount or limited amount of depth. So they'll be checking things like a request for disability benefits, and they only require a certain amount of documentation, and then they move on to the next. Typically, when the Canada Revenue Agency, CRA, decides to do an audit, it's because they've produced some random lists of targets. Perhaps they have certain projects. They've been known, for example, to identify dentists as being a particular issue, and they will go through a group of dentists in a particular postal code, and if they see the results that they expect to see or that they were hoping to see, they'll decide to expand that into a broader set of people in that profession, or perhaps other professional groups. There's also kind of a snitch line where you can call Canada Revenue Agency and say that your neighbor's operating a business and doing it off the books, or paying tradespeople in cash, and so on. And so that could also be a reason why you get audited. If you have partners or even a tax accountant who has been in trouble in the past, then that could lead to audits. There was one very famous tax accountant, David Ingram, operated out of North Vancouver, and he was famous for getting bigger returns or bigger refunds for his clients. He would advertise how often he beat Canada Revenue Agency. Eventually, Canada Revenue Agency got upset with him, and they audited pretty much all of his clients, and a lot of them ended up in trouble because they'd been advised by this well-known tax accountant. Generally, about 300,000 small business and self-employed people are audited every year, and at the end of the process, they'd receive a reassessment, which may say that they owe more, owe less, or there's no change at all in the original assessment. And there is a process of appeal that can, in some cases, take years. Some of the most obvious ways to trigger an audit, of course, your T4s, T5s, those slips that you receive are generated through a computer system, and if you don't enter that or don't provide that information, if you're doing paper versions, that could trigger an audit. certain expenses are much more likely to trigger audits. I don't think I've ever moved without having an audit of my moving expenses. So while they don't require that you submit all of the documents when you do the move, they can ask you afterwards to supply that information. If you're doing tuition transfers to a parent or to another relative, if you're paying support payments, if you're receiving the Northern Canada allowance, caregiver allowance, etc., those things are much more likely to trigger an audit. Claiming more than 50% of your home expense as a business expense. And I can tell you right now, if you try to claim on a square footage basis, certain rooms in the house, like your kitchen or your bathroom, say you claim 50% of your bathroom because you have to use it during working hours, they'll disallow that. Claiming too much of your car expense. Of course, your car may be used principally for business, but clearly you're going to be using that vehicle for other things unless you have another vehicle. And once you've been caught once, you end up on a very short list of people that they like to go back to and check again. Another interesting thing that Canada Revenue Agency can do, if they've not caught you any other way over a long period of time, they can do a net worth assessment. So if you've declared that over the last 10 years you made $1 million, but you spent $2 million on real estate, houses, and holidays and vehicles and things like that, if you spent twice as much as you've actually earned, then they can come back and impute or infer the total amount of income that you must have made in order to have that kind of expense. So if you can't show that you got the money from an inheritance from your uncle who sadly passed on or other source, you could be subject to them doing that thing that in philosophy they say that you can't do. Now, this is asking you to prove a negative, prove you didn't get the money from somewhere else. Right. Well, that's an awful lot for just the time that we've had today. This is covered in Chapter 4 of the Madura and Singh textbook in a little bit more detail and a little bit more depth. One last thing to think about, and like one of my other slides, this one comes from the Fraser Institute, a kind of well-known right-wing think tank, that an average Canadian family will pay about 45% of its income. For every dollar that you earn, nearly half of that dollar is going to taxes. Not just income taxes, there are a variety of other taxes, including things like goods and service taxes or sales taxes, property taxes, taxes on things like alcohol and cigarettes. So a significant amount of our money, and this essentially says that we work from January perhaps right through until the middle of the year. In this case, in British Columbia, it was June 15th. That was how long we had to work in order to pay off the government. Everything you made after June 16th is your money. So congratulations and enjoy it. That's all for today's session. I look forward to seeing you in our next classroom or next video session. Bye for now.